Welcome to TheoTrade. This is Don Kaufman. Here we are, June 24th, 2017, doing the weekend update. Let's get started with a bit of a review of some of the action in the previous week of trade. And then, of course, we'll take a look at not only what we can expect this coming week, but some specifics and some underlyings that you're going to want to be taking a look at. So I'll start with the SPX. And really the S&P 500 in general. So here we have the SPX closing the week out at 2438 and change. So what did the week ultimately come down to? The entire week can be summed up by, well, in the end, we did absolutely nothing. For those of you that don't remember this, last weekend we were just a few points shy of where we currently are. So if you look at this past weekend, all right, we rallied up huge. No, we really didn't rally up huge. Effectively, we started the week right around 2432 and change, and we ended the week at 2438 and change. The entire week can be summed up by a huge bid to the upside on Monday. And I want to get specific about this because what we were looking at last week, and again, these lines on the screen, for those of you that do not tune in on a day-to-day basis or a week-to-week basis, the lines that you're seeing on your screen over here are representative of expected moves. And this, again, is exactly where we started last week. That's the central point where we started, okay? This is the upside expected move and, of course, the downside expected move. And last week, we were expecting about plus 21 or minus 21. Well, the irony of that is we had a $21 move literally in the first day of the week. On Monday, we exploded to the upside by 20 points, okay? By the close, we faded just off the expected move. For those of you that tuned into the Monday evening session, we said fade the expected move, and that basically meant we should come in. Hopefully you guys listened a little bit to that one because these expected moves have worked phenomenally as of late. So in the S&Ps, we faded the expected move. What did the market do? Came right back into its expectations. Now, I'll talk about, I've already got the next week ultimately drawn out. Again, this being the central point. It's where we're currently at, which is 2438. And this coming week, we're expecting about a 22-point move higher or a 22-point move lower. That's the expected move. Again, I'll come back to that a little bit later. So in effect, the S&Ps do absolutely nothing. Now, let's go take a quick glance at the Qs. Okay, one of the things I've been pointing out, and we recently did a class on, is something I call this tetrapod spread. And what the tetrapod spread is designed to do, we've been buying premium in the Nasdaq and selling premium in the S&Ps. Now, the reason I'll mention this in the whole tetrapod spread, why would we go out and buy premium in one product and sell premium in another product? And the answer is, if you take a look at the Nasdaq, okay, all these little highlighted areas, this is when the Nasdaq exploded through its expected moves. So this is an expected move, it exploded through it, okay? Here's the very next week, an expected move, we exploded through it. Here, of course, another week, we exploded through the expected move that week. Okay, here's a week where the volatility is pumped up. We stay inside of it. And then once again, here's another week where we actually pop through the expected move. So, okay, in short, what I want to get to is the Nasdaq continues to exceed volatility expectations. In effect, the marketplace, and when I say the marketplace, okay, this is a marketplace. These expected moves are not pulled out of thin air. This is not Fibonacci's like, yeah, I got your 618 right here. It's not like that at all. The expected moves are nothing more than the option prices converted into distribution, okay? And on a week-to-week basis, I'm just taking the expected moves right off thinkorswim. Now, the calculation that's using thinkorswim, I have a lot of involvement, obviously, with thinkorswim for 15 years. Pretty comfortable with that. It's a very, very similar expected move calculation that's being used at a lot of the different market making firms and a lot of proprietary trading firms, okay? So that's why effectively we use it. And again, this is forward looking. But the interesting thing is if you look at option pricing, if you sell options right now in the Nasdaq, you're getting your head popped off your shoulders week in and week out. Okay, we're supposed to, and again, I'll zoom in on this, we're supposed to stay inside of this expected range 68% of the time. Does this look like 68% of the time? Okay, here we have a week exceeded, here we have a week inside, here we have a week inside, here we have a week explodes through, here we have a week explodes through. And you just do some quick math over here. You're actually trading outside of the expected move at the end of the week more often in recent weeks than you're trading inside the expected move. So effectively, we've got like, 60-70% of the time we're outside the expected move. That makes me still want to buy premium in the Nasdaq. And that's exactly what we have been doing. And again, we've built a couple of these tetrapod spreads. And you can see I'm actually buying premium in the Qs. And again, I'm actually buying premium in the Qs and selling premium over in the spiders specifically, or the S&Ps. So I wanted to review that a little bit because once again, the Nasdaq kind of exceeded. The Nasdaq expected move this coming week over here happens to be about $2.32. Now, before I go any further, I'll come back to the expected moves here a little bit later. Before I go any further, in this past week of trade, what we really want to talk about, and for this, I'll cruise over right now to the Nasdaq futures. Okay, it really has been a tale of two different tapes. There's this constant bifurcation of the marketplace, and this bifurcation, really what it comes down to is the Nasdaq, which after this kind of precipitous drop has been trying to regain some footing over here. All right, where are we right now? Well, if you count this drop all the way down to about 5,700, it's kind of where we stabilized at 5,700. We're basically sitting at 5,800. We've gotten half of it ultimately back. At this point, okay, take this rally back with a grain of salt. Now, I know a lot of people buy the dip, buy the dip, buy the dip, buy the dip because it's worked umpteen years in a row. But now we're starting to see, again, higher volatility. Look at the range. Like, do you see the different tone of trade in the Nasdaq completely? Look at the ranges on an intraday basis. This should intimidate even the most experienced traders because it's a complete, again, change of how products have traded. And if you looked at the Nasdaq, and again, you can look at Nasdaq futures, you could look at the Qs. Hey, listen, whatever does it for you, right? But you can go back over 3 years and you start to look at, other segments in time. And if you go back to, the beginning, if you will, of 2016, this was a much more volatile period of time. You see some pretty expansive ranges in here, right? Okay. And now you look at what we're doing right now and you're like, whoa, that's very reminiscent of what we saw. That's the last time we saw some real bout of volatility. Anyway, the point being over here is whatever's going on in the Nasdaq clearly is not over. But as I was saying, it's kind of a tale of this bifurcation. And the bifurcation is you've got Nasdaq, and we'll call the Nasdaq the Qs. I know I have the Nasdaq futures up here, but we'll call the Nasdaq the Qs. So the Qs kind of continue to run to the upside. But then this week, we've actually got the XLF, okay, and the XLE, which is energy, to the downside. Why do you think the S&Ps are completely flat over here? I mean, the S&Ps are right caught in the middle of this. And that is ultimately what's occurring. So if you start to look at the Nasdaq getting bid back up, cruise over to the XLF, okay? And the XLF, it's the financials. Great. All right, let's get specifically into it. The XLF faded this week from about 2460 all the way back into the 23 handle. Now it's under kind of that important level, very important level of 24. So we're starting to see, once again, financials fade over here. I'll come back to those in just a moment. In addition to it, okay, there is just no love whatsoever for the XLE, which is, of course, your energy sector. Caught a little bit of a bid on Friday, but generally speaking, okay, no one would touch this thing. And it's because oil now is to the lower end of the $40 a barrel range. Most of your energy stocks over there, your Exxon Mobils, your ConocoPhillips, your Chevrons, you have to recognize many of these firms say that they can't even make money until oil's at like $50 a barrel. And it varies per firm because of, where they're getting the oil from. Is it shale? Is it, deep water drilling, yada, yada. I can go into this forever. But there are firms out there that are even saying $60 a barrel for them to actually start making money again in oil. Other firms are yelling about $40 a barrel, which is pretty much where we are. It's kind of break even for them. So it's an interesting area, but that's that like, defection, if you will, in the marketplace. Now, let's come back around for a second to the financials, because there's an interesting trade going in here. And I have to tell you, the financials, more than really any product, have me a little bit baffled. And again, I don't mind ever saying that. They have me baffled because I want to show you something interesting in the financials and not enough people are talking about. So everybody's talking about, they're going to deregulate the financials. It's going to be spectacular over there. I mean, the gloves are coming off. They're not, at least at this point. And you have to recognize that a lot of the policy and politics played out right here. This explosion, if you will, to the upside. I think all the policy and the fact that they're going to repeal portions of Dodd-Frank, possibly the Volcker rule, was all ultimately priced in already. Okay, the part that has me a little intimidated about financials right now, financials react a tremendous amount to what bonds are doing. Now, I'm going to open up, a little bit more of a substantial chart on bonds. And this happens to be the ZB. I'm going to come in here. I'm going to contract adjust these things, hit apply, hit OK. All right. And what intimidates me? Okay. What intimidates me is this. When bonds had this monstrous drop off, this was the election. That's exactly where, as soon as the bonds had the monster drop off, that is part of what drove the financials substantially higher. And those bonds at the time were trading all the way up here at like this 160 range. So now the bonds have come all the way back up to, again, 156. They're just shy of like, pre-election. And you would think, though, that these bonds rallying all this time, you would think that that would put monstrous pressure into the XLF. If you think about the bonds, I mean, the bonds are almost back again to pre-election. Is the XLF back to pre-election? No, these things are trading near 24. Pre-election over here would be under 20. Okay. The way I see it, you got what? You're $4 better off than you were just, a few months back over there into the election. You're plus $4 on a percentage basis. We're looking at a phenomenal move that would have to happen, of course, to see the financials down. Now, why this intimidates me as a trader? Well, first of all, I have a short position inside of the financials. What I'm a little nervous about here is if the bonds were to turn around and sell off at all, it could fuel the financials to the upside. It would also take the S&Ps a little bit higher, okay? And, every up move in these bonds does not seem to be having negative implications to the financials, okay? But I am scared if the bonds do sell off here at all, that it could have positive implications, all right? And if you look at interest rates right now, they're getting clobbered on a day. Like, interest rates are so ridiculously low again. And so this is one that's got me a little bit perplexed, and I'm watching it on a day-to-day basis over here. But take it for what it's worth. The XLF is a very, very dangerous product at this point, as it is driving huge amounts of order flow. You can never diminish the size of the financials. And the reason I say don't diminish it, don't just look at the financial sector. There are a lot of tech stocks, that really trade with the financials. Look at stocks like PayPal and Visa and MasterCard. Those things are actually in the tech category, but they move with the financials. So if you kind of put it all in, financials are the biggest sector really out there. They still are larger, in effect, than most of the technology stocks. They can drive the marketplace because they have so much influence even into the technology sector. Anyway, I want you to think about that one in the coming days, coming weeks. Now, this particular week over here, it wouldn't do it justice if I didn't mention a little bit about retail. Okay, right now, Walmart. I like still a short position in Walmart. I do have a short position in Walmart. I am actually short physical stock in Walmart. I happen to also be long Target. Why long Target? It's getting clobbered out there. Exactly. Okay, elevated volume over here. The stock has just been getting creamed. So I've actually got a bullish stock position and a short-term just vertical spread for a pop to the upside over here. So again, I'm looking at a trade where I'm short Walmart, long Target, a bit of a pairs trade. To kind of continue on, there's one other really interesting trade that I've been looking at throughout the course of the week. And I'm going to go off the beaten path, and then I'll come back to what we can expect for this next week. And I'll be talking about this a lot throughout the course of this week, so tune in on a night-to-night basis. HYG, which happens to be junk, okay? The junk bonds got clobbered earlier in the week and actually rebounded. I'm looking for a short entry into HYG. I'll be using an options position. The reason I would use an options position in this particular circumstance is HYG pays an absolutely massive dividend that you don't want to mess with. I mean, that thing, it's junk. It's junk bonds, right? It's 5% yield out there. So be careful. You don't want to go out there and just start shorting shares of HYG. But there is going to be some pressure into HYG with oil being this low. There's huge exposure. Junk bonds have huge exposure to the oil industry, and oil going any lower than it currently is could actually spell a serious issue for HYG. Again, I'll kind of expand on that as the week progresses. Now, let's be a little bit forward looking what to expect this next week. Okay, in this next week over here, what can we really expect? So if you go over to the S&Ps, again, they didn't move very much this week, right? Again, this past week, we were looking for about a $21 move. And the irony is we got a $21 move on Monday and then contracted. This next week, okay, if we go out some 6 days, we're looking at about a $22 expected move, right? But here's the real story. Okay, the real story over here isn't so much like, well, we're not expecting a lot of volatility in the S&Ps. The real story is, okay, look at the differential of the Nasdaq volatility, okay, versus the S&P volatility. Now, this is highly unusual. A lot of people don't look at this stuff on a day-to-day basis, okay? But I want you to grasp is that if you take a look at again, this is a quarterly expiration because the quarter ends on Friday, but it's a 15% implied volatility. If you've never looked at volatility before, the cool thing about volatility is it's the great equalizer. You can look at QQQ volatility, it's at 15%. 2 seconds later, you can go look over at the spider volatility, okay? And the spider volatility is at 8%. So roughly speaking, you have to realize the Nasdaq right now is trading with almost double the volatility of the spiders. Now, is that normal? Okay? Well, the last time, quote unquote, that was normal, you realize you have to go back into almost the tech bubble times when the Nasdaq was already coming off in 2001 and 2002. Now, there's brief moments where the Nasdaq volatility picked up and doubled versus the S&Ps, but I want to take you back in time here for just a second, and I want to show you, okay, what normal might look like, because you can see I have actually been tracking expected moves, and I've actually got 3 years of data of expected moves drawn here on the thinkorswim chart. I've got about 16 weeks of data, but I'm going to take you right back into February and March by going over here to this into the Analyze tab and think back. I'll just take you back a few months over here to just glance at this. We'll just pick any given Saturday, right? You come back and you look at 6-day volatility. Look at the Qs. Now, again, what I want to display to you, the Qs were trading at about what? A 7.9 vol. And that was, again, on March 4th. You come over here to the spiders, not changing the date, just coming over to the spiders. And the irony, the spiders have what? An identical volatility, right? So for the most part, the Nasdaq and the spiders, they're one and the same. And as you move forward in time, and again, you start looking now, you're like, what? The S&P volatility is roughly the same. The S&P, okay, even look at the VIX, it's like 10, and all of a sudden you start looking at Nasdaq volatility, and it's effectively double what it typically is. So there is absolutely, without consequence saying this, there is still a whole lot of risk being priced into the Nasdaq, and you can't count out, again, volatility. Why is the volatility so high? Okay, there's a clear indication over here. Volatilities are high not because somebody's expecting an explosive move to the upside. Volatilities are prototypically high because everybody fears that risk to the downside. And if you start looking again at this Nasdaq chart over here, we've rallied back up. Take the rally again with a grain of salt. We're still not sure if this is a rally back up or if this is just going to be fading into the move. It's kind of a reload. The one thing that is very, very apparent, though, is that on a day-to-day basis in the last few weeks, these ranges are a bit scary. Okay, we've actually seen multiple days of 80 and 90 point ranges. Okay, here's a product that's $5,000, $800 product, and I don't care who you are, 100-point move in a product over there can be extreme. So it would not surprise me to see in coming days, okay, to see again even 200-point moves once again inside of the Nasdaq. There is a reason that the marketplace is not backing volatility down, and you need to again respect the fact that the Nasdaq volatility is near 100% greater than it is inside of the S&Ps. Thanks everybody for joining us here at TheoTrade. Join us all throughout the course of this week on these evening videos and in the TheoTrade chat room. Have a great weekend, everybody. Bye-bye.